On the one hand, we have a pretty disinflationary force from lower energy base effects, lower goods prices, lower food price base effects, so all comparing to a very, very high base to last year. So it's quite likely that over the next couple of months, we see, particularly in the US, headline inflation dipping below 3%. So I think the market is going to be caught up between sort of very strong labor market data on the one hand, but on the other hand, the disinflationary theme, that for risk assets overall doesn't have to be particularly bad, because what it means is that perhaps, we're going to get a bit of a slower grind lower in growth. We're going to be basically seeing a bit of a positive rate of change in growth. Look at the latest global PMI numbers that look a bit more encouraging, on our numbers that also is set to continue in the next couple of months. So a bit of better growth, very, very disinflationary trend in the US. The labor market, yes, pretty hot, but the average hourly earnings not really going through the roof and not really surprising massively to the upside. All that should actually provide for a pretty Goldilocks first half.
Max, tactically, though, if you look at some of these markets in Europe, we're traveling around the high end of the range, or a 5-year longer basis for like French and UK stocks. At this point, should you be trying to lock in some of those gains and pivot elsewhere?
I think from a hedging perspective, yes. I don't think the Europe and the EM or China trade are done yet, because what we are seeing just now is that particularly top-down growth expectations have just started to be revised higher, right? Let's remember that 2 months ago, the big consensus theme was that the first half of the year is going to be pretty bad, earnings recession driven by the cyclicals. That's usually felt most in emerging markets, in Eurozone, right? In the non-US markets, and thereafter we'll see a recovery based on a Fed pivot. That, in our mind, looks pretty much the opposite, right? Like basically now things are actually much better than expected, and particularly in Europe, right? Particularly in the Eurozone, where people are sort of scrambling to update their forecasts and upgrade their forecasts higher. And particularly also on the earnings side, we are seeing that really the cyclicals globally have seen the most downward revisions for Q4, so for the ongoing reporting season right now, and for the first quarter, so for the reporting season in April and May. So therefore, yes, very tactically, perhaps there might be a bit of a bit of downside. Perhaps it might be worth, from a hedging perspective, to pick up a bit of long dollar positions. But overall, I think that can continue, particularly into sort of the middle of Q2, with very, very downbeat earnings expectations.
Max, just briefly, I mean, obviously you're pivoting here to a much more risk-on stance, and you sound much more upbeat than you were last year. If you could pick out one piece of evidence or a few pieces of evidence, what was it you got wrong to make you as bearish as you were, that you're now having to pivot to this much more risk-on approach?
Yeah, look, I think what we've seen last year was almost a unanimous downward drift in our top-down leading indicators, right? So when we looked at PMIs, or we looked at things like housing, we looked at the labor market, and so on and so on. Now, the reality is that most of them are starting to stabilize. So leading indicators for PMIs are starting to stabilize. Input prices are suggesting that actually growth from here should have bottomed and it should be starting to progressively at least improve. Consumer sentiment is starting to improve. That should continue as well. As inflation comes down, that should actually make consumers feel a bit better. So it's not just a sentiment or a positioning driven rally. It's not just a rally based on very, very pessimistic expectations. It's actually one factor that has, or is still a bit underestimated, is that there is some genuine signs of improvement on the fundamentals in the past month or so.